You're listening to the Reinvest Podcast, where each Tuesday we show business owners and entrepreneurs how to reclaim, reconnect, and refocus their life by bringing you the top real estate professionals in the industry. We'll help you diversify into real estate by equipping you with the tools and tactics to build generational wealth. Your hosts, Garrett Gatton and Seth Ciminillo. Hey guys, thanks for jumping on to another episode of the Reinvest Podcast. Today we have the opportunity to be in studio with a great guest and a great episode.
It's always better in person.
It is.
You know
There's
what I
no
mean?
substitute. Yeah. And I don't want to get into it yet, but our guest today, he's got the trend factor going on. So look out for some fashion tips as well as we talk about real estate.
Let's get it.
But before we get in, there will be a link in our show notes for you to join what we call the Huddle. And that is our monthly update for Level 5 Capital with everything that's going on with the business, deal opportunities, investment opportunities, what's going on at a macro level in commercial real estate, and what we're seeing and how to make sense of that. So if you want to be a part of that, go into the link and go ahead and join the Huddle there. But we're going to jump in today. We have a great topic, and we've talked about short-term rentals before, but more in kind of a generic sense. Today, we're going to really drive down deep into more of the vacation, the experience side of it from somebody who's actually doing this at a high level. So with us in the studio is Angel Sanchez. What's up, man?
Hey, how is it going? Happy to be here.
Thanks for coming in the studio. Yeah, it was, the corner of our room.
The corner of our room, yeah.
So, Angel, why don't you tell us a little bit about your background, how you got into real estate investing? Disclaimer, we met a couple weeks ago over golf.
Yes.
Which, if you don't...
Who won?
Well, that's irrelevant, but I think...
It was a close game.
Yeah. Don't patronize me. That's a great way to network. But yeah, we met a couple weeks ago through a mutual friend, Austin. Thank you for the connection. And I was floored by meeting somebody who was both local in our backyard, but yet doing something that is successful, wildly successful at a high level, which is kind of why we're here today. So tell us a little bit about your background.
Who is Angel Sanchez?
Absolutely. Again, thank you for inviting me. This is great. I would love to share, my experience and everything that we have done in the short-term rental space. So, like you said, my name is Angel, or you can call me Angel if you're okay pronouncing it that way.
I was talking about this actually before you came, and I was like, I can't say it right.
Yeah.
So I didn't even want to try it.
Yeah, and
safe.
That's all good. I answer by both. So I'm originally from Puerto Rico. I'm a mechanical engineer. I have an undergrad in mechanical engineering. And once I finished, I was at the University of Puerto Rico in Mayagüez, which is like the largest engineering school in the Caribbean. Then I decided to pursue grad school. So I went to UC Berkeley, and I did my master's degree at Berkeley. I thought that I wanted to become a professor, so I was in a PhD track, and while I was doing the master's, I decided, I think I'm ready to make some money, especially living in California, where everything is so expensive. I was like, I think I'm ready to maybe start saving up and maybe buy a house.
Right.
You know what I mean? And then, so we decided to move to Lime, Ohio for work. I started working for a Fortune 500 company down the road here. And the experience was absolutely incredible. I was primarily a project manager. I was there for 5 years. So it gave me a really good grasp about construction, about project management, construction management.
Because was it for the build out that they were doing for Procter and Gamble?
Yeah, so I wasn't in the build out per se. I was in the Tide Pods business. It's called soluble unit dough. So I was the main engineer for the
Don't
converter.
eat those, by the way.
Yeah, definitely don't eat those. Anyhow, so I think my part of my experience in the past, and I can give you an example that was a huge influence for me, was my mom has a multifamily property. So I started seeing since I was a kid, cash flow going in from rentals.
In Puerto Rico.
In Puerto Rico, yeah, exactly. So to me, sometimes my mom wasn't at home, and the renter would go to me and hand me $500, $700 in my hand in cash. And I would be like, this is a pretty neat way to make money. My mom is not even here, and she's making $700. And the renter would be, can you give this to your mom? And I would be like, I don't know. I may just pocket it and buy a few video games. You know what I mean? But I think that was a big influence. If I look back now, with all my experience and the schooling and my profession, I think if I look back, I'm gonna say that was probably my main influencer in real estate, and seeing kind of like right there the positive effects of cash flow.
Yeah.
So let me ask you a question.
And also, we kind of glossed over this. So you started working at P&G, and you said and you're talking about your wife.
Yeah.
Okay.
My wife and I, we moved
and
here.
So where did you meet your wife? How'd you meet her? How'd you get married? And then you guys both are engineers, so that's kind of unique as well.
Yeah, absolutely. So I met my wife in college in Puerto Rico. I think we were in the fourth year of college or something. Yeah, I think it was fourth year. We met at a classroom. We were taking thermodynamics. I think she skipped her actual
nerdy.
session, and then we met actually doing like an in-class exercise in thermodynamics. I don't remember what it was. I was paying more attention to her, and like trying to think, how do I ask her out?
There's a lot of good pickup lines that you could go with in a thermodynamics.
Is it hot in here? I don't know.
Heat check over in that corner of the room.
Right. There's like a lot of chemistry and heat transfer between us.
That's funny. I wish you had said that. So you guys met in college, got married, moved to the States. We're both working at P&G.
Yep.
So one question though about your mom is it common for people to be real estate investors? Like for women like your mom, that demographic, to be investors in Puerto Rico versus, just in general?
Yeah, I'm not going to say it's pretty common. I'm going to say it's comparable to the U.S. And honestly, I don't know the statistics, like as many people, like how many are real estate investors. But there's a handful. I mean, the real estate market in Puerto Rico is actually pretty solid, especially right now. Especially right now with the short-term rentals being such a huge business out there. In Puerto Rico being a touristy destination,
right?
There's a lot of scarcity as far as long-term rentals go, because a lot of landlords are taking their properties and their units and turning them into Airbnbs.
Right.
So I'm gonna say right now it's long-term rentals are even more attractive in Puerto Rico because you can definitely raise prices. There's very little inventory and so forth. So I'm gonna say it's comparable to the U.S. as far as percentage wise.
But she was doing this when you were a kid, so she's been kind of ahead of her time in some ways.
Absolutely,
she's a veteran.
Yeah, she's a veteran for sure, and she's an entrepreneur, in the inside. She has her full-time job. She's a insurance agent.
Oh,
she has been doing that for like 34 years or so.
Wow.
She's about to retire next month. She was here. She left 2 days ago, and she's great. I mean, she has an entrepreneur mindset, super supportive with everything that I've done, in this space. Like, when I started, a lot of people were like, "You're crazy." Like, why are you going to put that much money into a business, into a venture that you don't know how it's going to turn out?
That's not the engineering way.
It's not the engineering way. It's definitely not the W-2 mindset for sure. So it's, part of the journey for me has been, how do I kind of like upgrade and change my mindset to, to be able to accomplish what we have been able to accomplish. Otherwise, if I stay with the 9-to-5 mentality, it would have been nearly impossible, to break away from it.
You were working at P&G. You kind of had the exposure for real estate, rental income, cash flow. At what point did you think that vacation rentals was something that was, there's so many strategies in real estate. Why vacation rentals? And why'd you pick the market you did?
For sure. So one thing really important to me was I didn't want to have my money, sitting in a bank account. I wanted to do something with it. I've always been kind of like self-taught and learning about, like the concept of money and being a fiat currency, like the concept of paper money. I wanted something tangible, an asset, limit my liabilities, and increase, buy assets that will increase in value over time. Another thing that we thought was like, we're engineers, and when we were working, we loved what we did, but we also knew that at some point we wanted to escape the rat race, we actually were pretty aggressive. We were like, we want to retire early. And I remember my wife and I, we always used to sit down and talk about our future plans and master planning and think 10 years, 15 years ahead. And we were like, we want to be retired by 50. That's how everything started. While we were studying at Berkeley, we were like, we want to retire at 50. And then we're like, why don't we retire at 45? And it kept coming down and coming down. And I remember my wife always told me since we met, she was like, once I have kids, I want to be a stay-at-home mom.
Yeah.
And, you know, at the time I was like, okay with it. And as soon as we had kids, I was like, man, you know, having a dual income family, they're expensive for sure. So part of the conversation that took us and brought us into the short-term rental space was we need to replace her salary. You know, that was one of the first equations that we tried to solve for, was like, how do we replace her salary once she becomes a stay-at-home mom? After she left P&G, I was like, I think I'm going to retire too. I think I'm going to leave too, maybe in the next year. And then everything went even more crazy because we were like, now we need to replace 2 salaries.
Yeah.
If you know what I mean? So
did you already have, so real quick, just to kind of give some people some context.
Yeah.
You guys bought vacation homes in the Smoky Mountains.
Yeah.
Did you have one of those before she retired? What year did you guys buy those?
Yeah. So the first property we bought, and I can take you through the process, how it took us there. But that was at the end of 2018. So I remember, I think that was the last day of the year when we got under contract or closed. We closed on the property the last day of the year in 2018. So that's how it started. So we were working full time. We had one unit, one property, a vacation rental. It was a cabin in Gatlinburg in the Smoky Mountains. It did great. It was amazing. Like, we didn't even expect that, you know, the returns that we were getting. And then we started learning and kind of like getting overload with information and knowledge and meeting people. You know, that was a huge part of the process, was like
people local to that, or are you
Yeah.
talking about people all over the country that were doing this strategy?
Yeah, all over, but particularly in the area that we were in, and we can talk about like the drawbacks and the different risks that we were taking at the moment. But one huge risk that we were taking was we didn't know many people in the area. You know, like we live in Ohio. We're investing in the market that all we know is on paper.
Right.
We haven't done it in the past.
Dude, that freaks me out. I kudos to you. There's a risk tolerance that you have to make that jump to out of state or out of area investing.
Absolutely. And when we started with the first property, we didn't even know who was going to clean it. So we purchased the property, and I did a lot of homework. Like, I had a list of cleaners and stuff, and we were kind of like in the interview process. But the most interesting part was, like, if you do your homework, you have really high chances that you're going to be okay, right? We ended up hiring good contractors, good cleaners. We were working remotely, so we were at P&G, but we were also self-managing the properties from 7 hours away, you know, and starting a whole new market. In fact, when we bought that property, or the time that we went house hunting, was the first time that we've been in the Smoky Mountains.
Wow. You showed up that weekend,
Yeah.
had already done some homework, and said, we're going to buy a house this week.
Yeah, and we got under contract that first day that we went, and we came back to Lima, I believe, the following day. We may have had like a couple hours to check the area around, but we left, you know, and we purchased the property 30 days later.
Wow.
So yeah, that's how we started. That was the first property that was kind of like the launch pad, what took us to what we are today.
So how many did you have when you guys started having kids and she stepped down from P&G, and you said, we now got to replace her income?
Yeah. So so the way it worked for us, after the first one, we acquired the second one a few months later. I think it was like 6 to 8 months later.
Now,
once we had revenue.
Talk about financing, like, you know, down payment wise, to be able to go 1, 2 within 6 months. You guys must have had some capital, kind of dry powder already set aside.
Yeah. So for us, I think we were in a fortunate position because we were a dual income family. We had good salaries, and we were saving a lot. I mean, we knew what the end goal was, you know, what we wanted to accomplish. So I'm not going to say we were frugal or anything, because we were not. Like, we were having a lifestyle that we designed for ourselves that worked for us, but we were saving enough to accomplish those goals too.
Right.
So for the first deal, I mean, this is at the end of 2018, real estate prices, especially in the Smoky Mountains, like the entry point was still, relatively affordable.
Like 500,000, 300,000?
No, way less than that. I mean, you could get at that time. I remember from our numbers and the yields that we were looking for was at least 20% return, and we were getting that in a $200,000 property.
Wow.
So I think at that time we put down 20%. I mean, we went the conventional way. We had both W-2 jobs. Like, it was pretty easy to get a loan, to get a mortgage for that amount of the property that we were buying. So yeah, I think all in all for that property, we ended up putting down like 40,000. Maybe at like 7,000 to furnish it and get it up and running. Like all startup expensive. And I think I mentioned to you this before the podcast, but that property, the first one we bought, we tried to mitigate some risks by buying it. It was already a short-term rental, so it already had some proven income and occupancy and things that we were looking to give us some sort of confidence going into a new venture.
Yeah.
Right.
So yeah.
Wow. So you guys acquired a couple, bought 2 of them. They were going well. You were self-managing them. You'd done your homework. You had all the right pieces, developing those local contractor relationships and the cleaning services. And then it was going well enough, evidently, that you said that you wanted to retire as well.
Exactly.
How would you guys like to buy 2 properties and then at that point say, I think it's within reach to go ahead and do this and retire?
Yeah, I think one thing that I learned, like at one point we were working at P&G and we were managing 4 properties, and they were self-managed, right, by us. Like we didn't.
That's a lot.
Yeah, for a short-term rental, I mean, it's a huge chunk, especially when you don't have a property management company doing it for you. Like, we wanted to save that property management fee, which could be between 20-40%, which is a lot that is going to eat up into your profits. So we were doing that, and once we started selling the properties down there, we saw a huge increase in equity, especially after COVID and a couple different things that were happening in the Smoky Mountains. We decided to sell to kind of like try to find a better market with better returns for our equity that we had at that time. So yeah, we were like, once we started selling and seeing the returns we were getting and the capital that we had access to, we said to ourselves, well, I think our time is better invested if we do this full time just to finding deals. We were comfortable enough to say, okay, with the capital I have, I think we can replace our incomes. I mentioned that. We were looking, that was our goal, was to replace both salaries. So we were like, I think we're at a point that we have enough capital and the returns that we have seen in the past and accomplished in the past, I think within a year or 2, if I dedicate my full-time job to, my full-time to find deals, I think we can get there.
Right.
So we were like, we want to find a better return for our time, and that was, I believe, in 2021 or so that started the conversation. My wife left before that, but that was the time that I was like getting ready to leave and dedicate my time to that.
So can I ask you a question real quick? I think one of the big difficulties in real estate investing is knowing when to pivot, when to hold on and kind of stay, through something. Things are going well, but was it the massive appreciation in your properties that almost forced you to consider going somewhere else? Because I'm just trying to think the thought process. You could cash that out and go into a new market that had a lower barrier to entry and still pretty good rates, for the cost to get in the game. Yeah. But had you not seen that appreciation, you probably wouldn't have sold out. You would have kind of hunkered down in the Smokies, or?
Yeah, definitely. I mean, like we knew going in that we were flexible. We wanted to follow the money. So once we saw the disproportionate appreciation that we were able to get within a year and 2, we looked at the numbers, and to us it didn't make sense at that time. I think I was mentioning this to you, but we got to a point that our return on our equity, how much money we had attached to the property, we were getting like 5%.
Explain return on equity for somebody who wouldn't understand that. How to even calculate that. Yeah,
absolutely. So you look at the market value of the property that you own. You essentially, if you have a mortgage, you know how much debt you have on the property. So you calculate how much equity. So based on the market value, you basically take in account your for example, your soft costs, like paying a commission and closing costs, and then take away the debt. How much you have left over there is how much equity you have on the property, and essentially is what you will get if you sell it. That's your proceeds. It could equate, comparable to the equity you have built up in the property. So that's money that you own, right? That's your money, and that's money that you could use for doing anything, right, with money. So if you divide that equity that you have built in that property by the amount of cash flow you're getting, that's your return on your equity. Okay, a lot of people uses different metrics. For me in particular, I use a couple. I use my cash on cash return, my return on investment, and my return on equity. What I've seen is, to me, is one of the most critical ones, because I could take that money and put it in a different investment vehicle and perhaps do even better. You know what I mean?
Return on equity almost shows you the opportunity cost of staying there versus deploying that somewhere else and maybe moving and snowballing that capital faster in a different strategy, a different market.
Exactly. And it depends on your risk tolerance. It depends on your strategies and tactics. You could either, do a cash out refinance and get some of that equity to you. That might actually end up costing you some money, because likely your mortgage payment is going to go up. So your cash flow is going to get hurt a little bit, but you have to put it into the equation and see what works best for you. For us at the time, we had that equity, and we were feeling that, there was a lot of supply going in the market too. So that was another factor that we were paying attention to. So one was the disproportionate appreciation that we were getting and the huge equity increase, but also seeing market trends in the area that made us think maybe we can just take that money and better invest it somewhere else that we feel more comfortable. Yeah.
So one thing I want to make sure that we hit, because I think this is really important in the conversation of short-term rentals, is what are the keys to running like a profitable, reputable Airbnb business? Because it is a business. It's not just rental income, lease it out, hold it. There is a strategy that you have to execute that is directly tied to the profitability of it.
Absolutely. And is Airbnb still the best platform? I mean, what platforms are you using and kind of along with that?
So to answer your question, so we use two platforms right now. So we use Airbnb and VRBO, or Verbo, how it's called right now. And both are great platforms. I think from the numbers that we have run in the past, I think Airbnb, we get like 65 to 70% of the business comes from Airbnb, and about 30-35 comes from Verbo, which is interesting because we started only with Verbo the first year, and it did amazing.
Wow.
We didn't even use Airbnb for the first year. And then we started branching out and kind of like broadening up our different exposure options. So we love both platforms. They both have their pros and cons. Their fees structures are different, but both work great. The key to short-term rental space is you want to get as many eyeballs as possible to your listing, to your property. So you want to put it in as many platforms as you want. There's a bunch out there, and they keep coming up even more. But you have like Booking.com. That's another platform that we've been thinking putting our properties. At this time, we were in a good position, and we were like succeeding and meeting our targets, that we're comfortable managing two platforms, that we don't want to add another one.
Right.
But those are the two ones that we currently have. Yeah. Another thing we have in the pipeline is we're going to start taking direct bookings, hopefully soon. So that means creating, your own website, having your own traffic, branching out and kind of like exposing and getting better in like the social media space. But those are the two that we use at this moment.
So what separates somebody from who's doing this as a hobby versus somebody who's doing this as like a business? Yeah,
so I think it's actually the seriousness of how much homework and you put into it to understand the actual business and the market and just the general space, but also is critical about how you track your expenses. So I mean, as in any business, you're talking about top line and bottom line, right? How much money, how much revenue I get, and how much I keep, essentially. So running a profitable short-term rental business is about how much money I keep in my pocket, right? How much cash flow. So a lot of people, what I've noticed is they don't necessarily have a huge appreciation for the expenses that go into a vacation rental in general. Because there's so many more expenses that you will have in a short-term rental than a long-term rental.
Yeah.
For example, cleaning, like variable expenses like cleaning, like supply. If you provide supplies like cleaning agents, if you provide like paper towels, toiletry, linens, that sort of stuff. Talking about like lodging taxes, a lot of people don't know, but you have to pay in certain counties, certain jurisdictions. You have to pay other taxes that are only applicable for short-term rental. In my case, I pay 6%, so that could amount to a lot of money, right?
Yeah.
If you
On
have
top of your property taxes, on top of
exactly. So there are other things that people don't think about, like things are gonna break. You have furniture, and unlikely you're gonna have nice furniture. So if your living room couch breaks down, you have to replace, and that might cost you $2,000.
That's why you go to these Airbnbs and they're like, there's like a manual just for the hot tub. They're like, please don't bring dirt into the hot tub, and you're like, yeah, because they're tired of it getting broken. They're tired of the filter going out.
Break glass in the hot tub. I'm like, why? What's the big deal? It's just a little bit of glass. The filter's made for that.
Yeah, until someone gets caught with that, and then you're
right.
in trouble. To add something there, I think another very important factor that most people don't consider is your continuous improvement, and that's something that we have been huge advocates
capital expenditure,
about. Setting aside a reserve budget or a continuous improvement budget, because competition just keeps increasing. So,
in what way have you seen the bar elevate in other listings?
Yeah, so there are different ways that you can differentiate yourself. You can either, provide better amenities, provide better design. That's what we have seen in right now, kind of like what is the trend is better design. It's could even be more important than amenities to some target markets out there, and they even be, willing to pay more for better interior design.
What would drive that? I mean, because I'm an amenity guy. I'm like, give me a ping pong table versus like a, and both are great too.
Versus a cool
like a
wall.
Nice texture wall.
Right.
Yeah. And that's a really good question. I'm going to say,
is it social media?
It's definitely social media. To
like
me,
it's more postable,
Absolutely. I was going to say, if you have an Instagram worthy wall, and where you can take as a guest pictures with your friends, with your family, post to get likes, I think that drives a lot of people.
Wild.
Which to me is pretty wild. Like you said, I prefer a ping pong table, but some people like a nice vanity in a bathroom.
What you got to do is a ping pong table and the nice textured wall. And then the people can take a picture in front of the ping pong table and wall simultaneously.
Boom.
There you go.
So we had a guy
or just paint the ping pong table pretty unique. Make a graffiti out of it, and you could
potentially look at these fresh ideas. Well, but kind of to complement or reinforce that point, we had a guy on that was in the like hotel venue space. And they do wedding venues, okay? And very premium, high-end places, like bougie stuff. And it's that same vein that people are spending like buku dollars more than ever before on weddings, on experience, on the visual aesthetic of it, so that they can post that, share that, kind of like put that out there or bring people in on that experience. It is a weird social like push because in the Midwest, like that's not my life isn't flashy. I drive a Toyota Camry, I dress like a dad, like it's just my life isn't flashy, but not, other pockets of the country where that kind of culture is more appreciated or desired. That's what people are willing to pay the premium for.
Absolutely. And I think you hit right on the nail. People are looking for experiences, and there's huge value in design too. If you are in a space that you feel, like it's contemporary, it's aligned with your kind of like design focused mentality, there's a lot of value to it too. Like how do you feel in that space? So
that's true.
So maybe a ping pong table, you can have a lot of fun, but you can also find a lot of kind of like peace. You can find a lot of like, happiness, I guess, in a space that you find, it's pretty, it's, it's.
So just to toot your horn for you, you showed me a picture of, on your Sweet Escape Cabin Instagram handle, of a theater room you did. And you could have just like painted the walls black, something that was dark, but you did exactly what you're talking about. Paneled walls, like lighting,
it's
really
so
cool
nice.
chairs. Like, I mean, like how much did that cost? And what was the inspiration for that was like, this is going to help us from a financial perspective?
Sure. So that project, probably one of my favorites. But that used to be a pretty boring, flat garage where we had a one pop table with two chairs and a ping pong table. Okay. So it wasn't flashy. It wasn't attractive. I even when I took the photos for that space, I was even kind of like embarrassed a little bit, like posting it because if I felt like it needed more. You know what I mean? Especially if you wanna charge, like top dollar, you want to provide something that is hotel-like, amenity. Design, colors, like you said, lighting. In our case, we added a lot of depth, so we wanted things that stand out from the walls and such. So that design, I use a lot of Pinterest too, and this is a tip for those who want to start in the short-term rental space that don't know much about design. Pinterest, you can get a lot of ideas out there. So I basically picked, whatever I felt, and this is a lot of this comes with experience too, with the many years that I've been doing this. But I was like, this is perfect for that space. And as far as costs, I think we ended up spending like $4,500 to $5,000 to build a full size theater
upgrade,
room.
Though.
Yeah, definitely. If I would have, and this was a DIY. I did this myself with my wife. She helped me out, and it took us about 4.5 days to do it. It was bang, like on the clock. I was putting like 14 hours a day to do it because it was in between rentals. Mm-hmm. So I had to block a couple of days to do work. But it turned out amazing, and the cost, if I would have hired somebody, that probably would have cost like $15,000 to do, maybe more.
Right.
Wow. It adds a lot to the kind of like appreciation. It forces equity on the property. And as soon as we posted the new pictures, bookings started flowing in. We increased the prices, and it worked great. I think the investment was paid off within 2 weeks.
That is crazy. Yeah. That's so wild. So
that's awesome.
It's amenities, but it's also design aesthetic. Kind of creating that. You said understanding top line, bottom line revenue, and those expenses, those hidden expenses. A lot of people don't understand as a differentiator between doing it as a hobby, like, oh, my family has a vacation, we stay there, but then we rent it out when we're not there, versus like we're doing this as a business.
Absolutely.
What would be just a couple other things before we get off this question that are differentiators in treating it like a business? Yeah,
to me, the biggest part is expenses, and the other part is like the market research, the underwriting of it. It's so much different, right? Like, I think you had we talk about vacancies, we talk about occupancy. So that's very different compared to like a long-term rental or a hobby, right? Like you have to pay attention into is this business going to be profitable? How much is going to be my projected yearly revenue or my monthly revenue? And how does that compare to my expenses? So to me, that's the most critical part that differentiates this with a hobby. If you want this to be profitable, make you money, you have to treat it as a business. Have your spreadsheet, have your expenses very break down to the level, to the highest level of detail as possible, so that you can track absolutely everything. So that's the key differentiator, is you need to pay a lot of attention into your expenses.
So that brings us right into the vacancy question. How do you get your data, and how do you account for vacancy within your short-term rentals? Because it's not like a long-term rental. If you're looking to get into long-term rental, you could probably call some real estate agents, or you probably maybe have a property management company and say, hey, what's kind of the vacancy rate in this area? Sure. And you can get a really good idea, depending on your stock, of what the vacancy rate is. And nationally, everything's pretty low anyway. So how do you get your data?
Yeah, so there's a few ways that you can go about getting your data for a vacation rental. And it's interesting because especially vacancy, at least in the past, is something that I have never consider per se. I look more occupancy rather than vacancy. Actually, if I think about vacancy, I think about it as a good thing in a vacation rental, because there's going to be a sweet spot of how much time during the month you wanted it to be empty, so that you can actually do maintenance work, service it, or upgrade. Upgrades, whatever you want to do. You need vacancy. So that's a huge critical portion of your equation, is how much percent of the year I wanted it to be empty.
But wouldn't you rather have the highest occupancy as possible and then book vacancy, around your schedule? And maybe that's what you're saying.
Yeah, in essence. So for us, for example, and I'm going to talk about some percentage that we normally use in our formulas. To us, our sweet spot is between 60 to 65% occupancy.
Wow.
That's what we have found to work best for us. One, because we self-manage the property. So more occupancy means more work for us. It means more turnovers. It means that the variable expenses are going to go higher because you have more cleaning, you have more supplies, you have more maintenance. So you want to have a healthy balance between your occupancy and your vacancy.
That surprised me. I guess I'm like, why wouldn't you want it as booked as possible?
And you may, right? It depends on what strategy you're following and what kind of like tactic you want to go for and how much work you want to have, right? So, and how much wear and tear you want to have on the you want the property to experience,
Right.
So for us, the 65%, it's kind of like in line to the average occupancy nationwide. I think it's between 55 and 60, the average occupancy nationwide. It may vary by market, of course. But where we're at, I think we're pretty comfortable with that amount of occupancy. And you also have to look at your average daily rate. That's, if you think about what are the two most critical metrics that you're looking at short-term rentals are your ADR, your average daily rate, and your occupancy. You don't think too much about vacancy, but yeah, it's super important too. But you have to make a balance, right? You can have a place rent for the 100% of the time. So let's say the full 30 days of the month for $100, right? But you can rent it 50% of the time for $200, and you're gonna have the same revenue with less wear and tear.
Yeah.
So that's where you have to solve the equation for what's your best occupancy that yields the best ADR.
For sure.
Interesting. One more question on that is how does somebody go about like evaluating a market? What are kind of the principles of doing that? Because the cool thing with vacation rental, short-term rental is the world's your playground. With data out there on any market, you can pick anything. So
and I don't even know if we said that, but you started in the Smoky Mountains, Gatlinburg, Pigeon Forge area, and you moved your portfolio. You sold that out, moved your portfolio to Hocking Hills, Ohio. So I don't even know if we mentioned that, but you've had experience now looking at two markets out of your area, and identifying good deals and buying them. So
yeah. So it's interesting, and I'm gonna jump back to a previous question you asked me of how I started. And like you said, the whole nation, the whole world is your playground, right? There's so many markets that you can pick from. In my case, it's funny because when I started, I looked at several markets, and the priority for me was I wanted to invest back home. I wanted to purchase properties in Puerto Rico. So when I ran the numbers and I started looking online, right, I was like, I don't know if the returns weren't that compelling for me at that time, right? I think right now that might be different. But I looked at other markets too. Like I was interested in the resort, like parks resort areas, like Orlando, Kissimmee in the Florida area. I look at more like the city space, like Chicago, New York City. But like the regulations were pretty intense.
Yeah. Right.
So we're like trying to be in a market that is flexible, that is open for business, that has a low barrier of entry. And one time I had a whole week conversation with a coworker of mine, which is to me mind-blowing. So I'm walking at work and he stops me and he says, "You have a motorcycle, right?" And I'm like, "Yes, I ride a motorcycle." And he's like, "You should go to Gatlinburg. Like they have some of the best mountain routes and roads for motorcyclists." And
Dragon's Tail.
Really? Really? And he was like, "Yeah, and it's one of the best tourism markets in the U.S. Like you have to check it out. So many attractions. Like there's anything for anybody to do down there." Yo, really? And I love to travel.
Right.
I've never heard about the Smoky Mountains. Yeah. And I was like, that was exactly at the time that I was underwriting certain markets. Wow. So I looked up Gatlinburg and I was mind blown. 12 million visitors. One of the largest national parks with the
most foot traffic,
most visitors in the entire nation.
Yeah.
I started looking at the vacation rentals. You could get a nice cabin that would get you 20-25% return for less than $200,000. I was like, he doesn't know that. I think he left P&G after all this happened. But if you're listening to me, hey, thank you. You gave me like the best lead ever.
What's wild is he was 3 feet from gold as well.
Yeah,
right?
exactly.
But you acted on it.
Yeah, absolutely. But yeah, so going back to your question about how do I underwrite and how do I get the data? So when I started, I looked up, everything is so readily available right now. Yeah. You have platforms and companies like AirDNA, Rabu, I think Market Finder, Matchvisor. There's a bunch of different out there that they could project yearly revenues in different markets.
Yeah.
The one that I've used the most is AirDNA, which you guys have probably heard a million times by now. But I have the premium subscription, so I get a lot of insider data.
Yeah.
A lot of insights. And I kind of like take their numbers, as, like with a grain of salt. I like to look at my competitive set even more than just looking at what they tell me a property could make. I try to look, what are my comps, my comparables. So I try to compete and try to be kind of like try to beat my competition photo by photo.
Oh, interesting.
Yeah, and I definitely have to look at what are my actual comps. Maybe AirDNA in their competitive set is including like a lodge with a pool. I don't have a pool in my property, so I need to exclude that. So I have to be very careful with the data. But I think it also goes with experience that you start to learn, and you have, for example, me, I have forecasted data for the next year because I have done it for multiple years.
Yes.
But when I started, basically was looking at that, looking what AirDNA tells me, looking at the competition. When I started, I was like so detail oriented. I mean, I still am, but at that time, I would literally go to Airbnb and Vrbo and pull almost all the listings that are out there, look at their calendars, their occupancy for the next 7 days,
You can
30
look at
days.
their occupancy. Oh, yeah, because you would go in as a guest.
As a guest, and you can see what's available. Of course, you're gonna have some outliers that are selling the property, and they
what a shark.
They block the calendars, but
Dude.
for the most part, you can see all that, and you can make some assumptions about how much money they make, and you can compare it to what the platforms are telling you, and corroborate if that number makes sense. So
just know if you have something in Hawken Hills, Angel knows more about your business than you do.
No, but I'm happy to share everything that I've learned in the past, and I'm always learning. So if somebody out there wants to kind of like hang out and talk about it and learn from each other, that'd be great.
The last couple of times we've talked to you now, I'm like, I just get so jacked up to buy like a vacation rental.
I know.
Yeah. So, all right, we're going to jump into our smaller pocket segment. So, Angel, go ahead and tell us about your worst real estate deal. What happened? What went wrong? And then what did you learn from it?
Man, I wrote down like 4 bullet points. So let me start with the first one. But I mean, I think we have been pretty successful and pretty fortunate with the deals that we have made. But there has been certain experiences that we didn't enjoy and that we learned. One of the after COVID, we had one property that we wanted to sell. So we bought this property and we only held it for 8 months, right? Well, it was almost a year, but it was 12 months that we held it. So just for capital gains purposes, we held it for a year, but we only rented it for 8 months. The first 4 months we were renovating, rehabbing, and getting it started up. So when we went to sell this property, the property was amazing. It was like a 3,700 square feet, 5-bedroom, 2-3 bathrooms, and the property appreciated so much, and I think we had it listed, and we had multiple offers, okay? So we had multiple offers. We evaluated all the offers, and I think we took the highest one. I think it was pretty competitive in general with all the contingencies and everything. The problem was the appraisal. So we were so excited, right? We got it under contract.
Started running the numbers on what you're going to cash out.
and the appraiser came back, and he said the property was worth $300,000 less.
Oh, my gosh.
Of what I was selling it for.
That's more than a haircut. That's wild.
It was wild. I was
Felt
in
sick.
complete awe. I was like, how can an appraiser, like this is a number that my realtor had like 10, 15 different comps, like straight apples to apples, like, hey, this is what they sell for. And she even had some that sold for more.
Wow.
So, and this is something that we've learned is like you got to build your team, and you got to build, you have to look up, you have to make sure that they're looking for your best interest. And I'm so glad and so happy that the people that we chose to represent us in real estate transactions, our real estate agent was amazing. Like, she was a shark. Like, when she heard about the appraisal, she would literally go straight up to the appraiser and be like, what the heck is going on? Like, like, can you explain to me? And she would even, she would persuade, that's something that you're looking, that your agent, represents you, is about persuasion. It's like, you need to convince them or influence them to do a second appraisal. which she did, and we accomplished that. And the second appraisal appraised right at the selling price.
Sometimes appraisers just make me upset, and I think there should be some accountability.
Yeah.
And I know there is accountability, but like just in that scenario alone, 2 appraisers, same property, same time period, same deal, $300,000 apart. And I'm just like, man, there should be some repercussions or something for a bad appraiser. But
So what happened on the second appraisal?
So it appraised.
Wow.
It appraised, and we were able to close on the deal. So that was great. But it was a super stressful, because the other thing is like when you go to sell an Airbnb, a vacation rental, Verbo, whatever, you have to take into consideration that whatever bookings you have after the sale,
Transfer.
you're still accountable, held responsible for those. So you have to manage
Wow.
that. So in our case, the best way for us that we managed was just block the calendar, because of course, closing is not a certainty, but, we don't want to have bookings the following day that we need to cancel them. And
Right.
you have a family that needs to rearrange their plans and find a new place. Yeah. So we block the calendar. So when they told us it's not going to close because it didn't appraise.
Now it's costing me money.
It's costing me money.
Yeah.
And in the vacation rental space, that could be a lot of money,
Significant.
It can be significant.
Wow.
So that was one. Recently we got under contract for a property, and everything was smooth until 2 days before closing. I think we were putting down like 25%, which was significant for a $600,000 property.
Right.
And 2 days before closing, the bank, I don't know, something came up or whatever, but they wanted an extra 5% down payment, which in that case was like an extra $30,000.
Wow.
And to me, it was like, that was a deal that the numbers made sense,
Right.
but they weren't as attractive as other deals that we have done. So I was already kind of like
on the bubble.
Yeah, I was pretty tight. I was like, I don't know if I want to put an extra $30,000. I would take my returns, I don't know, from maybe 12% to like 7% or something of the sort. So I was like, yeah, we ain't doing this. So we decided not to go with that deal just because the lender.
Oh, and it was the financing that kind of blew it up.
Yeah, it was the financing portion. So that was
Wow.
a bitter experience. And that was.
So did they explain? I mean, why do you think that is? Or did they explain? Did they say, hey, it's just because it's short-term rental as a bank, we just think it's a little bit more risky?
It was a commercial loan, and they were just baking in the margin, right? They were just.
Yeah, and I remember my mortgage broker, he sent me the email. He forwarded me the email from the lender, and the email, it was pretty vague, but it was one sentence. And the sentence, if I remember correctly, was like, we need more down payment because of the risk level of this little market in Ohio. That person mentioned it was
a little
market.
That's
or a little community. It was something like, but the person used little. And I was like, this is one of the most profitable markets in the entire U.S., which, man, it blew my,
It almost was like they were trying to belittle it a little bit. Just this little community, they wanted to throw that out to you.
So did the mortgage broker, though, I mean, kind of like your agent did you try to salvage that at all and educate them on how it was actually a very strong market?
Yeah, we try. I mean, like they do their underwriting, and they have all the data from my properties, which I share. I have all my P&Ls, my profit and loss. They know my revenue, they know my expenses, so they know the trends in the market. Like tourism trends are going up. So, I think it was just, I don't know, they were
so
extra cautious, and to me, it didn't work out. So we decided not to pursue that deal.
But you got to know when to say no. I mean, you could have made it work if you wanted it to be tight, but I mean, that's kind of a good lesson, and just be willing to walk away. Don't get so emotionally attached to a deal that you all of a sudden it's not a deal anymore.
Absolutely. And I think to your point, and that's huge in the short-term rental space, is how much wiggle room you have in the deal. You're talking about a space, an asset class that is generally more risky than long-term rentals.
Right.
But you also have higher potential returns, okay?
Yeah.
So you have to bake in, larger reserves. You have to bake in a larger yield and return that you want to accomplish with the property, just in case, like the market may go down or up. You don't know, there's certain things that you don't know, but you want to be in a good spot that you have enough buffer that if something happens, if it's not occupied for a month, you can still survive and stay afloat.
There was an investor, really wise guy, and he said, a great deal ends up being a good deal. A good deal ends up being an okay deal, and an okay deal ends up being a bad deal. So if you're buying it today and it's an okay deal,
It's probably a bad deal.
Yeah, you probably should pass on it, right?
Absolutely.
And so that's kind of what happened. All right, Ram, we're going to go into what we call our little nugget. So, Angel, this is the part of our show where you give our listeners one practical takeaway or piece of advice that they can implement to their real estate investing businesses. Maybe something we haven't talked about yet.
Yeah, for sure. And I think I can tailor this to two different target markets. I think the first one is for those who are interested in getting into the short-term rental space, and maybe secondly to those who are already in the space and want to grow, right? So the first one is like, when I started, we have very aggressive goals, okay? But we also knew that we needed to take action. So one thing that we have learned, and we have a lot of people, and I'm telling you, a lot of people that come to us and then they're like, oh, I want to learn from what you guys are doing. I want to do Airbnbs. Can you explain to me how to run the numbers? and I happily sit down with almost everybody that asks me the question and are, genuinely interested in getting into the market. The thing that I have noticed is the lack of action. Okay? And I think a big portion of it is just the analysis paralysis that goes with it.
Yep.
There's a lot of numbers. There's a lot of unknowns, especially if you haven't done any in the past.
Right.
But to us was taking that leap, taking the action. So the paper is going to tell you a story, right? So you either trust that story or you don't. So as long as the deal makes sense on paper, take the action. It's that to me was huge, was just changing the mindset. And like you guys said, I used to be a W-2 employee, and how do I change that mindset to being an entrepreneur and be more risk, forward and oriented. But at the same time, you have to know your limits. You have to know your risk tolerance too.
Right.
So think about that. Think about if you're starting out or you want to start, think about what are your limits. Set up realistic expectations. You may or may not get the returns that you're looking for. But at the end of the day, you have to try, I'm trying to remember. I had a really nice influencer in Instagram. I think he mentioned, like, it's not timing the market, it's being in the market.
Yeah, it's time in the market.
Yeah, it's time in the market. And I love that. I love that. It's you can sit down and look at the numbers, the full year, but until you take action, you won't see any results. So
right.
But know your limits and your risk tolerance. You don't want to do something that you don't feel comfortable with.
Yeah.
And you should be okay, with that decision that
You'll
make.
never get to the point where you've eliminated every variable. At that point, there's no risk involved, and then everybody would do it. So there's always going to be that element. And I feel like the reason people maybe hesitate is that's really what they're trying to avoid, is that crux of like, oh, I really have to put something on the line. I have to take a step of faith.
Absolutely.
Yeah.
And for those who are experienced, it's interesting. Like, sometimes you may think that it's going to get easier, but actually it's going to get harder.
Yeah. Well, because the risk gets bigger, right? I mean, because you talked about buying a $200,000 property when you started. Now you're talking about a $600,000 property.
Yeah, exactly. And not only that, I mean, you're talking about if you want to scale, like you said, I mean, likely you're going to need more capital. You're going to go with bigger, larger deals. But also, if you already have deals, things are gonna break. Things are gonna wear out. Right. So you have to replace them. Things that didn't happen when you started out are gonna happen later. And this is not. I'm not saying this comment to kind of like frustrate people or like demotivate people. On the contrary, it's like you have to stay. If you want to stay afloat and succeed, you have to stay on top of them.
Right.
Yeah.
Another thing that we have learned as experienced short-term rental investors is you got to stay on top and keep up with the competition. Competition is also getting like more, it's getting harder and harder. Like people know the trends. People are seeing what you're doing. They're going to compare to you and try to beat you, try to, like I say, it's the win photo by photo. They're going to try to beat you with photo by photo. So you want to differentiate yourself. And that's why it's important, like I mentioned, having a budget set aside just for continuous improvement, adding amenities, maybe working on changing the design.
Yeah.
Changing the photos every so often so that you can actually stay on top of the game. You know what I'm saying? So if you're experienced, you want to continue growing, that's one nugget that you always need to be paying attention to. Is like, it's going to get harder, and that's okay.
Yeah.
It's just staying on top of it, continue beating the competition. And another thing is like branch out, like there's other ways that you can get more occupancy. If your occupancy stays pretty flat, I mean, you can go with different platforms. Like, I mentioned like Airbnb, variablebooking.com, but right now the big trend is Instagram and social media. Like you can also branch out and start your social media platform, get more followers, get more eyeballs to your website, and start with direct booking. So yeah, I think those are really important, factors to consider and to keep in mind if you're running a successful vacation rental business.
What's been one of the best resources in your real estate investing development, your personal development?
Yeah, I'm going to say, so like I said, I'm self-taught primarily. I've never taken a course on investing or anything. Everything I learned from books, what I've seen in YouTube and Instagram, and kind of like learning from other people. So something really important is, have a coach, have a mentor. And a mentor doesn't necessarily have to be a person or like a real person. I feel like some authors from books are my mentors.
Right.
mentors.
Yeah. Right.
So whenever I'm working on a deal or thinking about buying something or doing something, I also think about like what are their recommendations? I try to have a conversation with them. Like what would this person do in my position? What this person would recommend me or coach me to do in this position. So I have different books that I read that were huge inspirations. There's one book that actually I recommend to everybody. It's called The Millionaire Real Estate Investor.
Okay. Oh yeah.
I'm sorry, The Millionaire Fastlane from MJ DeMarco. And
Okay.
And I don't know if you guys have read that book. The other one I think is from Brandon Turner, I think, or David Greaney, which is also great. But this book from MJ DeMarco was, I'm going to say this is the book that actually convinced me to quit my 9-to-5.
Really?
Nice. I'm going to read that.
What was the premise of it?
And then I'm going to quit my job.
Yeah. So that book focuses primarily on shifting the mindset of the 9-to-5.
Yeah.
And how to accomplish that and how to set up, like most people think that creating wealth or the general conception to create wealth is, like go to school, find a job, like get a profession, get a promotion, save up, put money in your 401k, retirement account, and you'll be good by
65.
year 65. So
if you live that long.
Yeah. So he calls that, a millionaire in a wheelchair. So he's kind of like shifting that mindset that, sure, it may take a long period of time, but you don't have to wait until you're 65 to accomplish those goals. Like you can branch out, you can venture, you can create businesses, and that's how most people, like the top 1% create their wealth is through businesses, creating businesses.
Because how old are you?
34.
Wow, that's wild.
I'm 34.
That's wild.
Yeah.
Good for you.
It's pretty cool. I hate to brag, but I like that I can say I retired by 32.
Yeah.
although I didn't retire, I probably worked more.
You're active on the real estate side now.
And I work on something that I passionately enjoy, so I can consider. You said it's a business, not a hobby, but to an extent, to me, it's also I feel very passionate. about it.
It feels different because you're working for yourself and you're building equity in yourself in your own company, and it's the freedom that comes all with that. It's all the good and the bad, but. Yeah, that's interesting.
Well, I think one of the distinguishments that needs to be made, because there's this conversation of like job optional and financial freedom and all this different stuff. At the end of the day, like you don't really want to wish away your purpose. Like you always have to have that. Absolutely. And work is a part of that. You want work to be enjoyment and purposeful. You found the two.
Yeah.
And there's flexibilities that come with it. So, but it's never going to be easy though. Short of having a trust fund. I mean, and I wouldn't even want that. I wouldn't want to be in that situation.
If anybody out there wants to put me in their will for their trust fund,
if they want to donate it, but
I'll take it.
Yeah, add me there, please.
yeah. Me and Angel. Garrett said he didn't want it, so
I stand on it. Yeah, gummit.
Yeah.
Hey, how can people find out more about your success and continue to follow that?
Yeah. So you can go to my Instagram account, follow me. It's called Sweet Escape Cabin. And you can see there all the updates for all the improvement that we do in our properties. We currently own 3 properties in the Hocking Hills area, Ohio. And they're very design forward. We have a bunch of different projects in the pipeline that we continuously post there so you can see what we're doing. We're going to start soon branching out and kind of like creating our own website. So once that comes, we'll definitely post that in social media and Instagram so you can you can see when you guys can book directly through us and maybe save some fees that you would have paid in Airbnb and Vrbo. So yeah, you can follow us at Sweet Escape Cabin, and you can see everything down there.
And if somebody wanted to go a step further and say, man, next trip I go to Hocking Hills, I want to book, a stay at one of your cabins. What's the group size that somebody would look at,
Yeah, so we have different group sizes. We're talking about, we have 2 properties that are for 8. So 4-bedroom, 2 or 3 bathroom properties. And then we have a large lodge, which is for 14 people, has 5 bedrooms and 3 bathrooms.
Awesome.
And all have huge amenities. The lodge has a theater room. It has a huge game room with a pool table, shuffleboard, foosball. It has a hot tub, swings, fire pit, basketball court, you name it. So a little bit for everybody. So it's a very nice for like big families or multiple families or big groups of friends, or even if you want to go and do a retreat, like we can, I'm sure we can fit your group there. And the other 2 are also pretty amazing. I mean, very design forward. Tons of amenities, hot tub, ping pong table.
Yeah.
All the properties, all the beds are king size. So anytime you go stay at our properties, you're going to have a big size bed. So,
Dude, well, you didn't get to where you are by accident. Being 34 now, and it doesn't happen overnight. It doesn't happen on accident. If you've listened to this, there's a lot of intention and planning and hard work and diligence that went into this, and that's not going to change, for anybody. You always have to have those elements. So cool to see you implement that in your business, and thank you for joining us in the studio today.
Absolutely, anytime. Thank you guys for having me.
Cool.
Yeah.
As always, excited that you joined us for another episode of the Reinvest Podcast. Stay tuned every Tuesday for new episodes. And if you want to learn how you can use your hard-earned capital to diversify into real estate, go to our website, lv5capital.com, and shoot us a message. Move farther, reach higher, and grow deeper. We'll see you next time.